Thank you, gentlemen. Gentleman from Nebraska, Mr. Fortenberry.
Thank you, Mr. Chairman, and I regret I didn't have the benefit of your earlier testimony, but let's go back to some fundamentals here. Let's ask ourselves a question. What is the purpose of the commodities market? And then I want you to answer what percent of people in the market now are hedgers, have commodity possession versus speculators?
The commodity markets, which go back over 150 years in regulated or in regular futures exchanges, help hedgers, whether that be farmers or ranchers or later on oil producers, to hedge a risk, and then speculators take on that risk.
I know the answers to this. This is just an exercise, as you understand.
All right, I understand, but I'm trying to best answer.
Yeah.
And so they're both very important pieces of the market. Depending upon the underlying commodity, some markets are more significantly have hedgers, some more significantly speculators. We recently broke out more of our data between producers and merchants, what you might consider a traditional hedger, and swap dealers, money managed funds, and the like. And generally speaking, less than half, but it depends on the market, less than half is usually the traditional hedger or producer merchant category.
Less than half since when?
I'm just referring to the most recent data. We can certainly follow up.
Well, it's my reason I ask is if the purpose of the commodities market clearly is to hedge risk, to decrease market volatility so that we have the vagaries of the economy are smoothed out and we have less potential disruptions because of the risky nature of growing crops or producing oil and the other production capabilities that we have in our country. If that system is broken and the market itself actually increases risk for the overall economy, do we have a fundamental problem here? Now, last year when we were dealing with this issue and we're going over and over it, trying to figure out where's the smoking gun, why are oil prices shooting through the roof when the underlying fundamentals seem to indicate that supply and demand variables were not consistent with such a run-up in the price. And, of course, that leads to an increase in price of the other commodities that are trailing behind it, particularly agriculture commodities, which ends up turning hog markets and ethanol markets and all types of production capabilities upside down. So now we're back home dealing with farmers who are in very dire straits because of something that they had no control over. We've got a fundamental crack or problem in our foundation here, in that the system designed to hedge risk, to ameliorate risk, actually has caused risks in the economy. And what is the underlying solution to that? Now, I know you're talking about increases of capital, transparency, and all swaps, all types of derivative markets are out there. Will that solve this problem? That's my point. I'm sorry to be a little bit testy with you earlier. That wasn't my intention. But just try to get to this fundamental point.
Well, I think you're right. All derivatives markets, whether futures or these things we call derivatives, OTC derivatives, are risk management contracts and price discovery markets. So people can discover the price of bearing that risk, or the price of corn or hogs or wheat. We are recommending that we bring regulation and transparency to the big part of the market that doesn't have it right now, the over-the-counter swaps marketplace, that we regulate the dealers, and that we bring the standard part of the market onto transparent exchanges. I think that goes a far way to the Congressman's question, but also to have the ability to set aggregate position limits, not only in the futures market, but across these markets where it affects the markets, particularly for products that have finite supply.
Do you think applying a test backwards in time, that a regulatory framework that you just described with increased transparency and requirements on all trades, no matter how you define them, no matter how they're sliced up, no matter how they're derived, having them open and clear as to what's going on would have actually prevented the type of run-up in oil prices and other commodities that went along with that, because even though their underlying supply and demand fundamentals didn't indicate the need for such or indicate a future possibility of prices reaching that level. So in other words, the market that's designed to hedge risks, to take care of market vagaries, actually caused the run-up in markets and the severe disruptions of the economy?
I think that given more tools, and this is true of both of our agencies.
Can you do that? I'm sorry, I'm out of time. Can you apply in real time what you're projecting into the future back to the situation last year would have prevented it?
I'm not able to do the hypothetical. It's a good hypothetical, but I'm not able to do that. But I think we'd bring greater transparency and lower risk to the system, and we'd have the tools to police against manipulation and corners and squeezes and other abuses that might be at the center of what you're saying. But we're also not price-setting agencies, neither of us. So there are going to be times that there are trends in investor psychology or in market psychology that also happens. We are there to make sure they're
well, your
fair
position
and orderly
limit issue should get to
yes,
that issue.
Yes.
All right. Thank you, Mr.